Good afternoon, everyone. Welcome again to the 8th Annual One Globe Forum. I am Aziz Lalji, and I am co-founder and chief operating officer of BrainGain. BrainGain is the parent organization of One Globe Forum, and we are an online marketplace for higher education tools, contents, and programs. Our topic today is on FinTech, and specifically how technology is affecting the creation and delivery of financial services, with a focus on India, but hopefully we'll get beyond India. To my left is Digvijay Kanwar. So Digvijay is country director at Fingerprint Cards, which is a leading global biometrics company based in Sweden. They have a multi-form fingerprint and iris recognition solution platform for mobile phones, IoT, and mobility applications. One of the primary use cases is in mobilizing biometrics for payment cards, with applications for banks, retailers, and consumers. Digvijay has spent the last 15 years in various strategic partnership and business development roles. He cut his teeth at Tulip Telecom, both in Delhi and New York. He is a graduate of Moscow Technical University and has an MBA from the Thunderbird School of Business at ASU. To my right is Saustav Chakrabarti, who is co-founder and CEO of Quotient Digital Solutions. Quotient provides personal financial planning and asset management tools to both individual investors and financial intermediaries. He has broad and deep background in investment advisory, wealth management, and retail banking. He was previously head of relationship banking at HDFC, and he built and grew multiple investment advisory and brokerage businesses at both MetLife and Citibank India. He's a graduate of St. Xavier's and has an MBA from New Hampshire College. And finally, we have Shalabh Singhal here. Shalabh is co-founder and CEO of Ziploan. So Ziploan is a sexy Indian fintech company. Ziploan is your typical venture-backed fintech company which is providing business loans to small and medium-sized enterprises in India. Shalabh previously founded two other companies, Beck and Ventures, which was a marketplace that connected lenders with small business borrowers, and Credence, which was a SaaS product for sales and marketing. He began his career with Goldman Sachs and is a graduate of IIT Banaras. So let me start with a question for all of you, and it's fairly straightforward. Take us to an individual user or customer of your product or service. What was the problem? What is your solution? And what game-changing role does your technology bring to the table? Depending on your business, is it the sourcing of the customers, the underwriting of risk, safety, scale, speed? Why don't we start with you?
Thank you. So we have different, obviously we have different product portfolios, and one of them specifically for finance, which will make more sense right now, is we've got a biometric card, which is essentially for a tap and pay technology. So as soon as you have dual interface payment cards, you don't require a PIN. And that means that there can be a lot of frauds. Essentially, a person holding onto a POS terminal going around in Delhi Metro could be tapping people's wallets and taking money out of it. If you introduce a biometric sensor on it, the authentication happens on fly. That means instantaneously, and you don't need to remember your PIN. Plus, your friends and family can't take your card for shopping. So it stays with you. So that's one part. The other technology that we were offering was for Aadhaar, is the iris. So in villages, people can make transfer, they can buy and sell things using our iris algorithm, which is connected through the bank accounts using Aadhaar. So both in a place where infrastructure doesn't exist, we can provide it through different means, and in a place where the cards do exist, we give it through biometrics.
Excellent, thank you. So this is a clear example of one of the enabling technologies, a fundamental enabling technology with primary applications for financial services. So, Saustav, if you want to talk about wealth management.
Sure. So within the financial planning domain, financial planning essentially is a process where you define your financial goals, you have a statement of where you currently stand financially, and how do you go from your point A to the achievement of your goals. I've been doing financial planning since 2004, and back then I remember technology was not obviously where it is today. A typical financial plan was expensive. It used to take about 15 to 20,000 to get it done. It was a time-consuming process. It would take anywhere between 3 days to a week because it was mostly Excel-based. And till that time, the customer had absolutely no idea about what quality of output to expect. Gathering the data was a problem. I mean, even till now, many people in this room, for example, may not recollect where all they have, what all invested. So it's very difficult to come up with all this data. So the whole process was fraught with a lot of difficulties, and it was cumbersome. Fast forward to 2019. For instance, we among other companies, what fintech companies have enabled today for these customers is absolutely low cost and phenomenally fast financial planning engines today. For instance, we're not the only company out there, but I can give you an idea about what we do. A financial plan today is essentially free, which means right down to the lowest strata of society, a person can actually go for a plan, have it done for themselves. It's simple to understand, it's easy. A lot of data is automatically fetched because there are a lot of institutions which allow access. And most importantly, it relies on instant gratification. Today, unfortunately or fortunately, a lot of people expect immediate results. They're not willing to wait for a week or even 3 days or even for till the end of the day to see results. Today, that is available, that is possible, and I entirely think that that's because of where the technology is today. So the experience of the consumer is much better today, and it enables companies like ourselves to actually offer this service at a very, very low cost. And a country like India, we are very big on inclusion. We want to include everybody in our journey. We cannot be an elitist economy where only 1% benefit, only 1% benefit from quality or even access to financial advice. Today, we are able to reach out to a vast number of people with financial advice because we are powered with technology. So that's my bit on that.
Excellent. So speed and scale and access for free. Shala, please.
Yeah. So we are a fintech NBFC, and we are focused on providing loans to small business owners. So just to put the things into perspective and to talk about the size of the problem in India, there are close to 60 million micro, small and medium enterprises in India. The way MSMEs are defined, these are businesses with their turnover less than 250 crores. But out of those 60 million MSMEs, 96% are having a turnover of less than 1 crore. And out of further drilling it down, around 84% have their turnover less than 10 lakhs. So this particular segment has less than 2% penetration by formal credit institutions like banks or larger NBFCs. And they have been funding their businesses largely through funding from family or friends, private money lenders, chit funds, where either the interest rates are exorbitant or they are not able to build a proper credit history. So if they have been borrowing 1 lakh, 2 lakh kind of capital for last 5 years, they are not becoming eligible to gain further capital from any organized lender. So we identified this problem in 2015, and the only solution to solve this massive problem is use of technology and strong data infrastructure. Why this problem exists is because since the ticket size for this kind of borrower, when we are talking about micro or nano businesses with their turnover less than 10 lakhs, is usually between 1 to 2 lakhs. They are not eligible for a loan more than that. At such low ticket size, any bank or other FI would find it unviable to run a profitable business with the manual processes. So you really need to automate and use a lot of data and experimentation at each and every part of your business, whether it's sourcing, it's underwriting, it's collections, to reduce the OPEX, reduce the TAT, because a lot of these businesses need capital very quickly. If there is some festival and they eye an opportunity, they need capital for their inventory. So they cannot be made waiting for another 3 weeks, 4 weeks just to complete the documents. And moreover, they do not have financial documents like P&L balance sheets, which banks require in other cases. So how can you find other sources of data, surrogate data to fund these businesses? Just to quickly give an example of one of our actual borrowers, initial borrowers, today we have funded more than 4,000 businesses. This guy was in Jaipur manufacturing jewelry pouches for big jewelers out there, sitting in a 10 by 10 feet kind of a workshop with 2 and 3 more workers working for him. And making jewelry pouches which were costing him 1.5 rupees and selling them for 2.5, 3 rupees. So making a 50% margin. Now this guy was rotating his whatever working capital he had invested 5 to 6 times in a year. So on the 2 lakh kind of capital, he was able to generate a sale of 12 lakhs. Just by funding him 1.5 lakhs at that time, he was able to double his annual revenue with the same kind of infrastructure. So this is how much impact could be made in the lives of these MSMEs, which are contributing 40% to Indian national GDP by providing them loan at cheaper rates and on time.
So you can see we have enabling technologies, financial planning, wealth management, and lending, and direct applications for the top of the pyramid to the base of the pyramid represented just at this table. As a quick follow-up, why now? To the extent you all are entrepreneurs, why are you doing this now? Why not 5 years ago? Why not 5 years from now? So sort of what unique mix of technology, demographics, policy environment are you trying to capitalize today?
So a lot of factors, and I think this is the ecosystem which has enabled all of this digital lenders or I think in wealth advisory to come up. So one is definitely the smartphone penetration in India and the plummeting of overall data cost. So we have completely leapfrogged where a lot of these applicants would have to use laptops or desktops. Everyone is on smartphone in our borrower segment. Second is the development of the consent layer and cashless transactions enabled by successful NPCI initiatives like UPI, Aadhaar-based payments or IMPS, NEFT. So there is a significant digital trail of transactions for these businesses. In our case, GST has been a big boon. So even if these businesses have a smaller turnover, but to be part of larger beneficiary of the overall GST ecosystem, they have enrolled for GST services, and now even they have their invoices and purchase data available digitally. So all of this is helping creating a lot of data on which you can monitor the loans, underwrite the loans, source the loans.
Yes, I have a simple answer to why now, because I tried earlier and failed. So I tried this back in more than 12 years back, and at that point of time I remember going back to the financial planning because we need to fetch a lot of data from different institutions.
You tried this business 12 years ago?
Yeah, a similar one. That time it was predominantly non-tech, but towards, within that business we tried to pivot into tech. And I remember walking up to all the asset management companies and the insurance companies and talking to them and asking them for access to customers' data, which was based on authorization from customers. And I got only dirty looks. They were like, what are you talking about? Yeah. So while he touched upon the social infrastructure which is available today in terms of higher number of smartphones, mobile networks capable of delivering, network connectivity and all of that, and of course some amount of government support through GST and some reforms. I would like to touch upon the fact that even institutions today are now open to allowing access, which they were not open to maybe 10, 15 years back. Because at that point of time, every institution was siloed, they were cloistered in their own environment, they were protectionist in their approach, and they held back information from the common public domain, thinking that they could use that only to their own advantage. And what happened overseas kind of swooped over India, and they realized that we cannot have that kind of protected environment. Yes, data needs to be protected, but institutions have to cooperate with other institutions, share that data for the benefit of all the users. And that's probably a reason why on the financial services side, now there is a much more deeper sharing of data about consumers. Of course, all subjected to authorization and consent from users. In some specific cases that has been misused also, But then again, every use case will have a misuse also attached to it. But I think that would be a large reason why we are saying why now.
So predominantly from our side, two factors. One was the tech itself. It wasn't that advanced at that time. You could not put such an advanced tech on something which did not require a battery, right? Power consumption issues was rampant at that time. So technology had not progressed, but at the same time, right now, I think so. India is one of the most a place where they actually do want to try out newer things. So it's an excellent test bed. It's an excellent place for implementation. Plus, the market is there, and the government policies have been really progressive with digital money. So I think so all those combination makes it a right point to enter here right now.
Thank you all. So notoriously in FinTech, direct to consumer is difficult because acquisition costs tend to be high, sales cycles tend to be long, and solutions that are fully automated on paper actually need a lot of handholding and practice. So one way around this is to simply partner with large institutions that actually own the customer relationship. So you'll literally partner with the banks and become a service provider. Or you try to go it alone and own the relationship and both sort of widen and deepen the sale. Can I have your perspectives on this? To some degree, Saustav, you've done both. Shalabh, you're going direct to consumer and you're enabling both again.
Yeah. So I think there's a push and a pull in both sense. Like you gotta create the ecosystem enough that people do realize that the value add to this. So from a B2C, as in the consumer itself sees the value addition and say, hey, I want to be part of that technology or should own that is secure, so that way. But at the same time, moving the whole ecosystem from the banking perspective towards the manufacturers and the supply chain in place, you got to build there as well. So yeah, you got to work at all the levels. You're not, even with the regulators in that sense, you cannot leave any part untouched. Yeah.
Specifically for our business, yes, we do believe there is an importance of the personal connect, the personal touch. Specifically in financial services, I don't think the country as a by and large is still ready to take advice from a 100% robotic advisor online. So from that perspective, a user does expect a certain degree of personal connect, and I don't think we're ready to let go of that just yet. On the other hand, while yes, initially it might be difficult and expensive to get users for any business to consumer product, but that is where word of mouth comes in. That is where if you've delivered value to a person's life, that person will go and tell another 10 people. The trick is to actually balance between how much you're going to deliver, how much of your experience is technology based and how much of your experience requires a human intervention. Now, I can give you our example. For instance, when we started, our technology component was lesser and the human component was higher, but every month that we go along in our journey and our evolution, we ensure that we are progressing higher and higher on the technology side and truncating the human element out of it. Being fully aware that we never want to get rid of the human element in its entirety. We still want to retain maybe the last 5% or 10% of last mile connect through a personal connect. But eventually, our business and much like us, any other fintech business will reach a scale where 90% of what we do, the entire user experience is technology driven. So over time, there will be economies of scale which will come into play. Over time, it will become easier to acquire your users because your brand value, your recall, your customer acquisition costs will drop. And I think sometime back in another panel, I remember they said you have to cross that chasm, right? So you just have to ensure that you persevere till then. It's a business of patience. It's a business of perseverance. And as long as you reach there, you will cross the chasm, and you will keep getting users. So
effectively, you're doing both. You're servicing brokers and intermediaries today, and essentially preparing for a day when you can directly acquire users and service them completely robotically.
Yes. So we have two lines of our business. So we have a business to consumer business and a business to business business. What we did is we started with the B2C, and when we started, because of the kind of value that we were adding to end consumers, what happened is on the financial advisory side, India is going through a lot of change. Where SEBI as a regulator is making it quite difficult for many distributors to conduct or go about their current business because of this so-called distinction between distribution and advisory. So when we started our business and we were offering financial plans in less than 30 seconds, essentially free, what happened is a lot of representatives from the financial intermediary community, independent financial advisors, wealth management firms, they reached out to us and said, by the way, there is this regulation in SEBI which says that if I have to distribute, I need to get a registered investment advisor to give me a financial plan. Now I can't go to anybody else because they will charge me 15, 20,000. You're giving it practically for free and you want users. Can you probably create a platform for us as an intermediary where I can do financial plans for my customers and I can give them that. So I stay true to we stay true to our advisory business and they can stay true to their distribution business. So it's a perfect synergy. It's a harmony, and probably that's what the regulator wants, that we each stick to our core business. So our B2B business actually started a year later from our B2C, and it started as, based on requests from the B2B community, from the distribution community saying, please build this product for us. And so
thank you. Is that working out? Are you pessimistic, optimistic? How are you actually engaging with this infrastructure core?
So now India's stack has a lot of offerings. Let's say eKYC, eNACH, eSign, and then your UPI transactions, and then a consent layer to get access to some more data points. Obviously, as I think most of us will be aware, eKYC is not working as of now. We are using eSign, eNACH, which is not as prominent as eKYC was in solving some of the KYC issues, but it's helping. And we are optimistic that over time, again, eKYC should be aligned. I think there's also optimism that with the India's tech layer, the overall consent layer would be developed much more further. So today, if you have to acquire someone's past ITR data or income tax returns data, or you have to acquire GST data, again, the customer experience is not seamless in sharing that data with the lender. So with the India stack consent layer being deployed in much more data sources, the data gathering cost and the overall data authentication would become much more easier.
I noticed you conveniently left out Aadhaar, and rightfully so, because that's a pain area for all of us. Yes, with Aadhaar, there was this brief period when all of us heaved a sigh of relief and we were like, wow, this is the holy grail, and now everything will be interconnected and life would be much simpler. But then again, it's India, it's never so simple. So we are also hopeful that Aadhaar makes a comeback. It is a very, very potent tool. It's a social infrastructure, it's not just a number. It's not just an infrastructure, it's a social ecosystem that is built around that particular identity. So yes, we are also a bit affected right now. We've had to kind of scrap a couple of things that we were trying to do. For instance, one of the programs that we run is for first-timers in the world of investments. Students, and for people who just joined a job fresh out of their college. We, on our financial literacy side, we ensure we talk about the importance of savings. And now, because we are not an asset class, or we are agnostic on asset classes, so we don't go about talking about mutual funds or stocks, because many of these people don't understand all that. So we make it very simple, or we wanted to make it very simple, where they understand the importance of savings and they can just immediately get started with a recurring deposit. So we tied up with a couple of banks and we wanted to do literacy programs where first salary and they could immediately set up a recurring deposit. Unfortunately, the banks that we're also working with are facing challenges because they cannot support, without the Aadhaar infrastructure, they are not able to support creating those accounts. So yes, there has been a little bit of impact, and we are also hopeful, much like Shalabh said, that it will make a comeback. But these things evolve over time, and I think in India, like I said, just like with our business, with any infrastructure in this country, we have to be patient and we have to persevere, and things will work out. But the general direction is positive. It's okay. It's never a straight line upwards. There will be, troughs, crests and troughs. So that's perfectly fine. But the infrastructure is great. We can actually do wonderful stuff. One of the things we're working on is a multi-asset execution. So you can pretty much buy anything through a platform, and it's, again, not just us, there's a lot of companies working on this. And a backbone of that would be the entire India stack, and Aadhaar would be a kind of a very big prerequisite for that. So the infrastructure is great, has its own hiccups, but I think it'll improve over time.
Thank you. Digvijay, let's appropriately end with you and knowing your customer.
Firstly, I resonate with the whole group, right? I think so we are headed in the right direction with Aadhaar and the India stack and UPI. Personally, I'm a big fan of Aadhaar. We end up giving a lot of solutions for Aadhaar as well, and there are a lot of startups which were working on the eKYC space, and right before it was smacked down for some time. That's what we're expecting. But I think so it is really enabling finance to flow much more freely. I think so a lot of people, a lot of startups the financial inclusion is actually happening now in a way. They're with this whole credible infrastructure in place, we were able to reach out to people which earlier was not possible, just because that infrastructure didn't exist. Now with that, and literally we did something which nobody else around the world did, and we should be fairly proud of it. It was a really nice thing. So yeah, highly optimistic. I think there's a lot to go also. There are always improvements in system, but using the India stack, UPI, ABEP, Aadhaar-based e-payment gateways, I think so it's a good story for us.
Thank you for sharing your thoughts on how FinTech is disrupting finance.